Back. Rajeev Thakkar also joining us on the show today. Rajeev, good to have you back with us. Lots to discuss, in particular, of course, the ongoing debate around valuations as the markets continue to inch up further from these record highs. What's your current view on how things stand, and do you feel there is still value to be found as we are also starting to see broader participation?
Surely, if we look at trailing earnings, then markets seem very, very overvalued. But the difficulty with trailing earnings is that 2020 has been an exceptional year in terms of the pandemic and where everything has got disrupted. So, what is a stable level of earning is what people are grappling with. It's easier to go stock by stock and figure out whether this stock makes sense to own or not own, but it's difficult to take a macroeconomic call or to predict, let's say, nifty earnings. So we are likely sticking to more simpler businesses where we have visibility. Overall, it's a difficult question to answer. There are surely pockets of over-exuberance. So we are seeing that in, let's say, some of the very small companies or some of the IPOs in the US and things like that. So clearly there are pockets of froth. At the same time, there are businesses which seem reasonably attractive to hold from a 5-year plus kind of perspective.
In terms of the kind of pockets that you're continuing to focus on, big tech, Rajeev, let's talk about that. We just heard this exclusive conversation with the management at TCS as well. When you're taking a look at the way forward, what's the opportunity that you feel remains when it comes to some of the larger tech companies?
So I think pandemic was made to order for these larger tech companies. So if we break up the individual segments, the TCS management spoke about the shift towards cloud. So players like Amazon in terms of AWS or Microsoft Azure or Google's GCP, all these have been seeing increased traction because of the pandemic. If we look at the home entertainment, the streaming content, so all these companies are benefiting, be it Amazon Prime Video or YouTube or Netflix. Given the health concerns, e-commerce has gained market share over physical stores. So that plays into a company like Amazon. Work from home is accelerating the adoption of some of the tools that Microsoft provides or Google provides in terms of remote collaboration kind of thing. Again, digital advertising has gained significantly in the current environment over print or electronic or outdoor. So broadly, it's been good for all these companies. And the interesting point to note is that the frenzy is on the newer listings in the tech space, whereas the existing large tech companies, because of the sentiment around increased EU regulation or antitrust, because of all those kind of things, the valuations in the big tech have not shot up. So companies like Facebook, Microsoft, and Google are around 35 times trailing earnings. So valuations really haven't shot up to that level.
Sure. Rajeev, you've had ITC as well in your portfolios. Given the underperformance that one is seen with ITC and all the concerns around whether or not it's ESG compliant, etc., and the diversification that they've had in hotels as well as FMCG, are you rethinking your investment in ITC at all? Although it's begun the move off late, but very late in the day.
So ITC is a recent purchase for us. We have not been holding it for a very long time. So ITC was first purchased by us in March of 2020. Around 140 rupees was the first entry price for ITC. So you are right. ITC has not done much over the last 3-5 years. However, you look at various stocks in their journey, they have these extended periods of time where either they correct due to excessive valuation in the past or some patch of a low growth kind of scenario. So one of the current favorites, for example, Hindustan Unilever, has seen such a patch in, let's say, 2002 to 2007, when we had one of the strongest bull runs in the Indian equity space. HUL was a big underperformer in that cycle. Similarly, ITC has been a big underperformer over the last 3 to 5 years. The other businesses that you mentioned, things like hotels and all, have been a big capital sink. So it's not been a great capital allocation. And the management has realized that. So recently they have announced the measures whereby they will not be putting in incremental resources into businesses like hotels. The new FMCG play has been a long gestation play for them, and which has in fact been probably a cause for the underperformance, because they were investing all this while. The new FMCG businesses were running at a loss. That is broken even, and that is now growing at a decent clip, that is adding to the margins. So time will tell whether it's a correct purchase or not, but it's a recent purchase for us. And wherever a stock has underperformed for 3 to 5 years, probably it gives an entry opportunity at attractive valuations.
Makes sense. Rajeev, along with ITC, are there any other names where you've invested in afresh?
So in the last 6 to 8 months, we have added some of the Indian platform related companies where there's limited competition, where there's fee visibility. So one of the things that we did was we reduced weightages in the lenders. So be it private sector banks like HDFC Bank, ICICI and Axis, or the Bajaj Group in terms of their lending businesses. And we have increased weightages to the fee-based companies like MCX, CDSL and IEX. So these are either monopolies or duopoly kind of businesses, and where there's a big amount of operating leverage, which benefits them as and when the volume growth comes in.
Rajeev, I don't see lenders in your portfolio. Once upon a time, you had Axis Bank and HDFC Bank. Is this a conscious move? Because if you're bullish on economy, then why no lenders?
We have lenders. They are at reduced weightages. So HDFC, Axis and ICICI, all of them are at around 3% each. So add up to about 9%. Further, we have Bajaj Holding, which is an indirect play on Bajaj Finserv. That again would be adding to roughly 3% if you look at the auto and finance breakup. So total we have about 10 to 12% weightage in lenders. I think the pandemic will be great for the lenders a few years down the line, because competition has reduced, the interest rates for their borrowings have come down, lending rates are a bit sticky, they are still at somewhat elevated levels, so margins will improve. But the next 6 to 12 months or maybe 18 months could be uncertain and tough. We are currently in a period where either moratoriums are there or restructurings have happened and things like that. Finally, what is the impact of the pandemic on the bad loans is yet to be seen. Right now, everyone is positive. People are saying things are fine, don't worry, it'll be at the margin. But we are taking a somewhat cautious stance here, and we'll see how things play out before adding to the weightages here.
Rajeev, if flows are coming back to emerging markets, could there be a risk to US tech stocks, not for earnings but purely because of positionings? I read a report last evening which said that the assets under management which currently are there with a firm like Vanguard, they touch $1 trillion. Those are ETFs. If there is a reversal in developed market flows or the concentrated benchmark ETFs, big US tech companies could suffer. Is this a realistic concern? Now there is no way you and me can establish it, but it's a concern which should one be mindful of.
So yes, meaning for some people it could be a point of concern, but as you rightly said, there's no way you and I can predict these things, and most of the time these shifts are temporary in nature and they even out. So, for example, did we know that we are going to see such a big sell-off in March and April? We had no idea. And again, uh, did we have an idea that before even the vaccinations have started in India, we would be touching at all-time highs? I don't think we foresaw that either. So when we are looking at 3, 5 years, 7 years out, we tend to ignore all of these factors and focus on where the business is going. So if we look at 5 years out, 7 years out, I would think that e-commerce would still gain share over traditional retail. Uh, Streaming media will still gain over linear television. Digital advertising will be a bigger piece of the pie as compared in the overall advertising pie. So the work from home and collaboration tools will play a bigger role in our lives. So from a fundamental basis, from the business trends, I think these companies are well positioned. Uh, they have run up very, very sharply in the short run. So could there be a price correction? Sure, there could be. Meaning, uh, I think this year has taught us to live with volatility, and a 5, 10, 15% down move can come anytime in any of these stocks. So I think we'll have to learn to live with that. We are not obsessing too much on the flows to the individual markets. Again, 65% of our investments are in India. So if emerging market flows are strong, that portion will gain, and maybe the US stocks will languish for a bit. It evens out over a period of time.
You've never got tempted to buy a PSU stock. Is there a reason why you've avoided or consciously avoided PSU stocks?
We have owned them in the past, and it's the pain that PSU stocks have given us over the years that has gradually led us to reduce the weightages over there. The last PSU that we owned was Indraprastha Gas, which we sold within the last 1 or 2 years, not too long back. Essentially, in the PMS days, maybe a decade and a half back, we used to own the oil retailers, and we saw crude oil prices going up and they not being allowed to increase the retail prices. They suffered on account of that. We owned a one-off PSU bank where again the businesses were not run very efficiently. So over the years we have graduated towards owning private sector businesses rather than owning too many PSUs. Sure, the valuations are very, very tempting in many of the PSUs, and if strategic sales happen, then the prices could run up quite significantly, because under a new management with full business outlook and profit motive, they could turn around. But under government ownership, I don't see them doing too well.
All right, Rajiv, really appreciate it. I'm so glad you could join us and have a wonderful year ahead.